We are diving today into, well, one of the really remarkable corporate stories of the last, say, decade.
Ørsted.
The Danish energy giant. They were once the global poster child for the whole green transition thing.
Oh, yeah, absolutely. They moved completely away from fossil fuels, became the undisputed leader, really, in offshore wind. Quite the transformation.
Legendary, some called it. And they became the darling of the ESG investment crowd.
They really did. But then, well, that valuation just evaporated, didn't it? In 2023, 2024, Ørsted got forced to book, what was it, own 40 billion Danish kroner in impairments.
40 billion.
Ouch. Yeah, and they canceled those flagship U.S. projects. It triggered this dramatic strategic collapse.
40 billion Danish kroner just wiped out. I mean, that's a staggering failure, especially when you think about their track record before that. How does the best execution team in the world get so absolutely crushed?
That's the question, isn't it? Our mission today, I think, is to really analyze where the business model went wrong, that fatal flaw. We need to dissect the management failures, too.
And then figure out if the stock, because it's trading at these like trough distressed levels now, is it a real generational deep value opportunity? Or is it just a trap, laid by this permanent political risk?
Exactly. Is the damage temporary or permanent?
Okay, let's unpack this. Let's start right at the core. How did they actually make money?
Well, fundamentally, they build these massive offshore wind farms. Then they sell the electricity. Often, it's through these long-term contracts, PPAs, power purchase agreements.
Okay, so that sounds pretty straightforward. Like a simple, stable utility model. Build a plant, sell the power.
On the surface, yes, they are a utility, but their real high-growth engine, the thing that powered that expansion, it wasn't just engineering, it was a financial innovation.
Oh, okay.
Yeah, the farm-down model, that's the key.
Tell us more about that, the farm-down mechanics, because you said this is where the vulnerability crept in, right?
Precisely. So Ørsted takes on the really risky, capital-heavy part, the development, the construction, billions of dollars, years of work.
High-risk phase.
Very high risk. But once the wind farm is actually operating, producing power, it's de-risked, you see.
Right, it's proven.
Then they sell off a big chunk of the equity, maybe 50%, sometimes more, to institutional investors. Think pension funds, insurance companies, people looking for stable, long-term returns.
Okay, so they get cash back.
They get cash back, they book a nice development profit, and critically, they recycle that capital immediately into funding the next wave of mega projects.
Ah, okay, so their whole financial stability wasn't really based on the cash flow from the wind farms they already owned and operated.
Not entirely, no.
It was dependent on constantly successfully building new projects and having those stable capital markets ready to buy the stakes in the farm downs.
You've got it. It's really more like a construction and project finance company disguised as a utility.
That's a really important distinction. A project finance company in utility clothes.
It is, and that's the structure that just threatened everything when that perfect storm hit in 2023 and 2024.
Right, talk about that storm.
Well, you suddenly had three things hitting them all at once, shattering that model. You had supply chain bottlenecks, making parts hard to get and expensive.
Yeah, we heard a lot about that.
Then relentless cost inflation across the board. Steel, copper, labor, everything.
Making their project budgets obsolete.
Exactly. And the final nail, a sharp, really rapid rise in interest rates that just blew up their construction financing costs and made those old PPA prices, the ones they locked in earlier, look completely uneconomic.
And that inability to execute quickly or profitably led straight to those massive DKK 40 billion write-downs and canceling Ocean Wind 1 and 2 in the U.S.
That was the direct result. And the market's reaction, it just proved how fragile that core farm-down component was.
How so?
S&P, the credit rating agency, they explicitly linked their downgrades of Ørsted's debt to the company's inability to execute a planned farm-down of the Sunrise Wind project. Yeah, it basically showed everyone, plain as day, that when capital markets seize up or investors get nervous, that recycling mechanism, the absolute heart of their financial engine, it just stalls completely.
Okay, that makes sense. But it forces us to ask about competition, about their moat. You hear a lot of analysts say, look, Ørsted has no real economic moat.
Right, the standard argument.
It's capital intensive, electricity is a commodity, and they're up against giants, RWE, Iberdrola, even oil majors like Shell and BP getting into renewables. Why should anyone think this business is actually special?
Well, I think that view is maybe a bit too simplistic. It's true they don't have like a network effect or a unique patent protecting them, but they did have something very real.
Which was?
Experience. 30 years focused purely on offshore wind. That builds up this deep, almost tacit knowledge, how to manage risk on these huge, complex projects, the specialized engineering, the construction logistics.
Okay, so know-how.
Exactly. Their former CEO was famous for treating these multi-billion-dollar projects almost like a manufacturing line, just systematically driving down costs risk. That's how they helped cut the cost of offshore wind by over 65%. It was a temporary, yes, but very real execution advantage based on experience.
But if that expertise, that know-how, is their only real edge, how long can that last? Couldn't deep-pocketed competitors like Shell or BP just, hire away their both engineers, poach their talent? Is an execution moat really durable enough, especially given the financial stress they just went through?
Well, the crisis kind of answers that question for us, doesn't it?
How do you mean?
The fact that they ended up absorbing billions in cost overruns, that they couldn't pass that inflation through to customers or off-takers. That's pretty definitive proof, I'd say. The moat is clearly narrowing.
So the fortress was breached.
Absolutely. And look at the new CEO's plan, cutting 2,000 jobs, talking about right-sizing. That's basically an explicit admission, isn't it? They have to stop trying to win on sheer volume and pipeline size. They need to compete purely on efficiency now just to survive.
Okay, but let's look at the counter-argument here for a second, because this is where it gets really interesting. Equinor.
Ah, yes.
A world-class competitor in their own right, huge offshore experience from oil and gas. They know this stuff. In 2024, they bought a nearly 10% stake in Ørsted.
9.8%, yeah.
And they specifically called it a counter-cyclical investment.
No.
What does that tell you?
That's a stunning piece of data, isn't it? It's a massive validation. Equinor, perhaps more than anyone, understands the real intangible value of Ørsted's execution expertise, that organizational knowledge.
Right.
So right when the market sentiment was at absolute rock bottom, maximum pessimism, Equinor steps in and buys a big chunk. They're essentially betting that the intrinsic value of that engineering and project management know-how is way higher than the market was giving it credit for, despite the recent, management blunders.
Okay, so Equinor sees durable value there. Let's talk about where Ørsted goes next. You mentioned management failures. How do we analyze that?
I think a useful mental model here is the circle of competence. Think of Ørsted's story in 2 acts.
Okay.
Act 1 was the brilliant expansion, transforming from Dan Energy, the oil and gas company, into Ørsted, the renewables leader. They cleverly leveraged their existing offshore engineering skills into a new domain. They stayed within or intelligently expanded their technical circle of competence.
All right, that makes sense. So Act 2.
Act 2 was the catastrophic failure, and I think the key here is that they fatally strayed outside their political circle of competence, specifically in the U.S.
Political. How so?
Well, think about it. They grew up in Europe, especially Denmark and the UK. Relatively predictable, generally supportive regulatory environments for offshore wind. They understood how things worked there.
But the U.S. was different.
Completely different ballgame. Much more volatile, politicized, complex state versus federal interactions. They just seemed to misjudge that environment badly. And the ultimate proof, that unprecedented event, the U.S. administration issued a stop work order on the Revolution Wind project when it was like 80% complete.
A stop work order on a nearly finished multi-billion-dollar project.
Yes, that's a political neutron bomb for a project developer. It just completely blew up their risk models and assumptions about the U.S. market.
Okay, so that failure, that misjudgment of the U.S. political landscape, it perfectly rationalizes the new 2025 strategic plan then.
Absolutely. You look at the plan, it's not about global domination anymore. It's a clear strategic retreat. They're pulling back, focusing resources, and doubling down on their core, durable circle of competence, Europe.
Makes sense. Retreating to home turf where they understand the rules of the game.
Exactly. Now, let's bring in another mental model, incentives. Charlie Munger's famous line, right? Show me the incentive and I will show you the outcome.
Always a good one. How does it apply here?
Well, pre-crisis, what was the market rewarding? Growth. Pipeline size, gigawatts under development. That was the metric everyone focused on.
Right. Growth at all costs seemed to be the mantra.
So what was the incentive for management? Grow the pipeline, bid aggressively on new leases, new projects, maybe without enough margin of safety baked in for things going wrong. And the outcome? Overly aggressive bids and then getting hammered when costs rose.
Okay, so incentives drove risky behavior. What about post-crisis? Have the incentives changed?
The rhetoric certainly has. The new CEO's incentive is clearly survival, first and foremost, and restoring credibility. So the new mantra is all about value over volume, a stricter, more value-focused approach to capital allocation.
And they put a number on it.
They have. They're targeting a, seemingly rational 13% return on invested capital, ROIC. That shift sounds absolutely vital for recovery. Focus on profit, not just size.
Sounds good. But I sense a but coming.
There's a big but. Here's probably the most concerning governance issue that the crisis really brought to light. Management has negligible insider ownership, like almost none.
How little?
About 0.004%, 0.004%, basically zero skin in the game.
Wow. Okay. That's not ideal.
Not ideal at all. And while the strategy now talks about ROIC, guess what the new Executive Long-Term Incentive Plan, LTIP, is still tied to?
Uh-oh. Let me guess. Not ROIC.
Nope. It's still primarily based on total shareholder return, TSR, relative to their peers.
Wait. So the strategy says focus on value, be disciplined, but their bonuses depend on the stock price beating competitors.
Yeah.
Competitors who might still be chasing growth.
That's the fundamental contradiction. It's a huge governance mismatch. The board is effectively telling them one thing with the strategy, but incentivizing potentially the opposite behavior with their paychecks.
So it encourages the exact kind of value-destructive bidding or chasing growth that got them into trouble in the first place, especially once the memory of this crisis starts to fade.
Precisely. It's a long-term risk. So if you're investing in Ørsted now, you're not just betting on the operational turnaround, you're also betting implicitly that the majority owner,
The Danish state?
the Danish state, which owns 50.1%, you're betting that they will ultimately enforce rationality and value discipline, overriding or compensating for the board's failure to properly align management incentive.
That's a big bet on government oversight acting rationally.
It is. Okay, so let's talk financials. The balance sheet obviously took a massive hit. That FFO to adjusted net debt ratio collapsed down to, 13.2%. Very stressed.
Yeah, dangerous territory. But then came the rights issue.
The DKK 60 billion rights issue. That was the ultimate backstop, wasn't it? Fully recapitalized the company. Took solvency risk right off the table.
And S&P confirmed that, right? They downgraded the rating, but kept the outlook stable because of the recapitalization.
Exactly. So the immediate bankruptcy risk is gone. Which leaves us with a recapitalized company, the leader in European offshore wind execution.
Trading at a misery valuation. You mentioned trough levels. What are we talking?
Yeah, roughly 0.77 times price to book value. That's deep distress territory. It basically implies the market thinks the damage from the crisis is permanent, that the business is structurally impaired.
Okay, so if solvency isn't the issue and they've retreated to Europe, where does future growth come from now? It's not global GW expansion anymore.
No, the new growth engine, at least for the medium term, is simply the profitable execution of the projects they're already committed to building in Europe. That's about 8.4 gigawatts. Specifically, the big ones are Hornsea 3 in the UK and Baltica 2 in Poland.
Just build those on time, on budget, and profitably execute the farm downs.
That's the plan. Deliver on the existing commitments, generate cash, rebuild the balance sheet further.
So what permanent risks remain that could justify that really low 0.77x price book valuation if solvency's off the table and they're back in their comfort zone?
Well, two big ones stand out. Number one is political risk, and it's not just about the U.S. anymore. That U.S. stop work order, it set a global precedent. It showed governments everywhere that even in developed markets, these multi-billion-dollar long-duration energy assets can become political hostages. That single event permanently increases the perceived risk, and therefore the cost of capital, for the entire offshore wind sector globally, not just for Ørsted.
Okay, a systemic repricing of political risk. What's number two?
Number two is the one we just discussed, capital allocation risk. That unaligned management incentive structure. As long as management is paid based on relative TSR rather than disciplined value creation like ROIC, the risk remains that they'll revert to value-destructive behavior once the immediate pressure of the crisis fades.
Right, the governance flaw. So what are the catalysts for recovery? What should investors watch for?
It's actually pretty straightforward, almost boring. The main thing is just steady, on-budget, on-time execution of that European construction portfolio. No more negative surprises.
Boring is good in this case.
Yeah. Boring is beautiful here. But the key market catalysts, the signals that will likely move the stock. First, successful execution of more farm downs, like the recent sale of 50% of Hornsea 3. That was a positive sign. Need more of those.
Okay, proving the model still works in Europe.
Exactly. And then the really definitive signal that the crisis is truly over, the reinstatement of the dividend, They're currently targeting that for 2026. That would be huge for market confidence.
Right. Brings income investors back, signals stability.
So this really brings us to the final decision point, second level thinking. We have two competing narratives.
Okay, lay them out.
Level 1 thinking, the crowd's view, is basically backward looking. Ørsted is broken. It's a no-moat commodity business caught in political crosshairs. Too risky.
Okay, the simple narrative based on the recent disaster.
Right. But level 2 thinking says, wait a minute, maybe the crisis wasn't the end. Maybe the crisis was the cure. It forced the recapitalization. It forced the strategic retreat to Europe. It forced a supposed shift towards value over volume. So the level 2 narrative is, we're buying a recapitalized best-in-class European operator trading at 0.77x book value. The market is making a mistake. It's conflating a past catastrophic capital allocation error, primarily in the U.S., with a permanently impaired operating business.
So the bet is that the core European operating business, building and running turbines, is still world-class and fundamentally sound.
That's the essence of the bull case at this valuation.
Okay, so summing this up, what does it all mean for you, the listener, the investor looking at this? The core tension seems to be this. Is today's distressed price just reflecting maximum pessimism on what was ultimately a temporary, albeit severe, setback? Or is 0.77x book the correct price for what is now essentially a politically captured utility? A company whose potential high returns will inevitably get capped by governments who feel they bailed it out.
And that really is the essential uncertainty, isn't it? The whole bull case rests on the idea that Europe is the rational, predictable, stable counterpoint to the volatile U.S. market where they got burned.
But is that assumption safe?
Well, think about it. If this global perfect storm of inflation and supply chain issues has permanently damaged the underlying economics of offshore wind everywhere, making it much more expensive, will European governments really stand by and watch a recapitalized Ørsted start generating, say, that targeted 13% ROIC? Especially after the Danish state just orchestrated a DKK 60 billion rescue?
Probably not. Politically, that looks terrible. Allowing a company they just saved generate potentially high returns while energy prices might still be high for consumers.
Exactly. It seems far more likely, doesn't it, that those governments would step in. Maybe with windfall taxes, maybe stricter price caps, ensuring that Ørsted's returns don't get too high, effectively guaranteeing that the company's long-term returns never significantly exceed its cost of capital. So the real risk isn't just operational anymore. It's that we might not be buying a high-returning utility at a discount. We might be buying a de facto state-influenced enterprise whose upside is permanently capped by politics.
That's the crux of it. We might be buying stability, but perhaps not high returns.
Yeah.
And understanding that political circle of competence, not just the technical one, is probably the key lesson from this whole saga, regardless of whether you decide to invest in Ørsted or not.